Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. It is once again that time of year when we outline our expectations for the most important themes for 2023. In this first session of the year for the Under the Lens video, we will talk about the major macro themes for 2023. In the upcoming version of Long Wave, we will specifically detail our investment themes for 2023 that are supported by these macro themes. Listed here are last year's 2022 themes, along with this year's 2023 themes we will be discussing in this session. To the right of each macro theme is the highlight we will be primarily focusing on. Before we get into each one of these themes, I think it is helpful to start with the larger picture for context. In this year's thesis paper entitled A Great Stagflation, which is available on the Matasi website, we used this generalized illustration to represent what we envision is ahead of us for most of this decade. We've referred to this era as the beta drought decade. We are presently in an era of economic stagnation, currently highlighted by inflation beginning to transition towards disinflation and then the deflationary impacts of the coming recession. With elevated inflation, slow economic growth, and soon to be seen surging unemployment, we'll begin to feel what we have been referring to in our newsletters as the Great Stagflation. This will likely be followed by a debt crisis with government and central bank-driven hyperinflation to support problematic fiat currencies and unsound money. Violent volatility in all markets, equity, bond, credit, currency, and the derivative swaps market, is highly likely to become the increasing norm as we exit this period that is generally referred to as the Great Moderation, an era which was punctuated by falling rates, strong employment, mild volatility, weakening growth, and historically strong financial markets. Though we see a weakening growth rate of inflation in 2023 as we fall into a recession, inflation is a long ways from being over and will be with us in waves throughout the decade. Inflation will most likely be most evident and pronounced in basic needs, products such as energy, food, and in the developed economies as imported goods and commodities. Inflation plus deflation will both concurrently be with us, but in different areas, and more accentuated in the different areas and at different times. If history is any indication, they will both continue to come, as I said, in waves. It is likely to be a difficult time for financial markets overall. The everything bubble is likely to regress back to more normalized values similar to how the markets behaved in the years following the Nifty 50 bubble and the dot-com bubble collapse in the late 90s. This doesn't mean markets will simply collapse. We can't ever be certain because many of the event drivers and decisions to be taken have yet to occur. However, looking at the major macro forces currently soundly at play, these forces are likely to push financial markets in the direction of a major classic top. A top highlighted by the factors labeled here, which again we highlighted in this year's thesis paper. Stagflation consists of three drivers: inflation, slow growth, and unemployment. You need all three to be in play concurrently to reap the unfortunate ravages that stagflation evokes. All three will be felt in 2023. I spent a lot of time exploding all three in this year's thesis paper, so I'll not do this here, but instead highlight a more focused view for each in 2023. The first is inflation, which though it was evident to all in 2022, it will continue to be with us in 2023. The area I want to highlight is how it will further accentuate a living wage crisis. This crisis will not only be felt in the U.S., but globally. Markets are presently focused on the rate of change of inflation. The rate went up in 2022, and the rate is presently falling. Month-over-month numbers are key to the traders, and to a lesser extent, the year-over-year rate. However, inflation is a cumulative issue to the economy. And what I mean by that is that inflation rates go up, but when they go down, the prices paid do not. They not only stay up, they continue to rise, but only at a slower rate. Though costs continue to rise or possibly just remain elevated, disposable incomes are permanently damaged. That damage takes time to be felt as consumers and companies adjust. Demand is eventually and normally forced down. This chart was a featured chart at the World Davos Conference this year as the World Economic Forum surveyed 1,200 global leaders in all facets of economics, finance, and government. Out of over 30 major concerns, the cost of living was number one, seen in the upper right. It was felt to not only be a concern but a crisis. The top right box also highlights energy supply, rising inflation, and food, also seen at crisis levels. All will be with us for a while. We presented this schematic in early 2022 to warn then about what was unfolding and the waves we anticipated and still anticipate. At its core, inflation has become about what we need, not what we want. The sustained period of asset inflation will soon be dominantly behind. It was an era where new wealth allowed us to chase what we wanted, which drove appreciation. Instead of financing what we want, we're entering an era about being able to pay for what we need. These are secular issues, not the cyclical issues we have grown accustomed to. The Great Moderation is highly likely over. The Great Moderation began with high rates falling and has been maintained by continuously falling rates until we reach the zero bound. It has changed because historically, when inflation gets above 5%, for any period of time, the adjustment to the cost impact and crushed disposable incomes has a profound and lasting effect. The second element of stagflation is economic growth. This is now beginning to happen as the cyclical business cycle comes to its inevitable conclusion. The business cycle has had a long duration and was primarily sustained by multiple rounds of quantitative easing, which delivered its intended stimulus goal of actually bringing demand forward. Therefore, it would be expected under normal circumstances to be a harder recession than normal. Of course, such a reality is politically unacceptable. Unfortunately, the reality is exactly that, reality. An inverted yield curve at historic levels of inversion is screaming recession. However, it may be signaling more than just that. It is clearly saying the Federal Reserve is behind the curve and is currently making a serious mistake in its slow response in lowering rates. Of course, this is the problem with stagflation. To fight inflation, you need higher rates. To fight slowing growth, you need lower rates, the proverbial catch-22. Global manufacturing growth is not only slowing, but has now entered contraction. A reading below 50 is contraction, and yet rates are still elevated. Remember, it still takes a year for reduced interest rates to work their benefits through the economy. International Monetary Fund, World Bank, OECD, World Economic Forum, and every global institution who monitor these numbers is all out warning in the strongest way possible of their concerns. Remember, these institutions don't normally do this and historically have proven much too optimistic. On the left in this slide is the IMF forecast showing a global slowing to 1.1% in the developed economies. On the right in red is the World Bank's current forecast showing a global low in 2023 of 1.7%. To quote the World Bank, global growth is slowing sharply, with worldwide economic output projected to be just 1.7% in 2023. The downturn will be widespread, and any adverse developments risk pushing the global economy into a recession. Slowing growth affects 95% of advanced economies and nearly 70% of emerging markets and developing economies, with the potential for increasing poverty rates in some regions. End of quote. The surest way to confirm these numbers is to look at the U.S. consumer, who has long been the engine of global consumption demand. That engine appears to be quickly stalling as the COVID-19 stimulus checks and loan, mortgage, and rent forbearances expire. Shown here on the top left is a plummeting U.S. rate compared to a resulting exploding level of credit card debt. Shown on the bottom right is the resulting inflation-driven interest rates on credit cards that U.S. consumers are facing. Shown on the right is the charge-off rate that cards such as the Discover card, which traditionally targets low to middle income households. Wall Street was simply completely caught off guard by it. Credit loss provisions across the big four banks this quarter jumped the most in a decade, excluding the COVID-19 shock. Banks clearly see a wave of defaults coming. The credit cycle has turned as this business cycle comes to an end. The third element of stagflation is unemployment. Frankly, this is the least appreciated of the three elements of stagflation. We first started warning about the degree of layoffs already occurring in November. It was getting little attention when we outlined the facts shown here. It has only got worse since, but again seems to still be underreported. I think the lack of coverage is because the numbers seem small in comparison to what we have seen historically when the numbers were 40 or 60,000 in major corporations. Today, since outsourcing and downsizing has occurred, employers don't have large numbers, or at least as large numbers. That is why it is important today to look at the layoffs as a percentage of the number of their employees. This chart is an easy way to visualize this. On the left are the headcount and cuts during the 2008 financial crisis for major banks. On the right is what has occurred recently. The vertical black line approximates headcounts of 75,000 as just a benchmark. Headcounts are dramatically less, so even minor cuts today will have major impacts within these organizations. Corporations like the banks shown here have been squeezing employee headcounts during the last decade to maintain profit levels as sales growth has slowed. With inflation surging, the ability to cut headcount to shore up profit squeezes is greatly impaired. The Financial Times in London is reporting, and I quote, "Banks are gearing up for the biggest round of job cuts since the global financial crisis as executives come under pressure to slash costs following a collapse in investment banking revenues. The layoffs, which are expected to be in the tens of thousands across the sector, reverse the mass hirings banks made over the last few years and the reluctance to fire staff during the COVID-19 pandemic. Job cuts that are coming are going to be super brutal." This according to Lee Thatcher, owner of a financial services headhunting firm, Silvermine Partners. It's a reset because they overhired over the past 2 to 3 years, according to him. Banks including Credit Suisse, Goldman Sachs, Morgan Stanley, and the Bank of New York Mellon have begun to cut more than 15,000 jobs in recent months, and industry watchers expect others to follow suit, emboldened by the headline-grabbing plans already announced. End of quote from the Financial Times. I encourage you to check out the link on the bottom right of this slide to the layoffs of 101 companies in just 3 months in the Silicon Valley area, which Wolf Richter had to manually pull out of California state filings to get any visibility on what is going on. This chart going back to the 1950s shows a trend line in red that gets larger with each instance of economic problems. Corporations have become accustomed to immediately cutting staff while the total economic cuts get larger. With the percentage of employees now being the key number and the total layoffs of all companies growing, it points out just how devastating the impact could be to the economy during the next period of layoffs. A new era of concern for 2023 is the fallout from the recent U.S. midterm elections, where the House majority was passed to the Republican Party. With a $1.7 trillion omnibus bill pushed through as the last act of the departing Democratic House, we can fully expect the upcoming lift of the debt ceiling to accommodate this spending to be a major point of contention this year. Frankly, the lifting of the debt ceiling, shown here in green, is usually nothing more than a joke. Congress has a record of simply seeing no need to restrict spending, shown in red, and a debt ceiling is only for public consumption of creating some appearance of fiscal responsibility. However, with the 15 rounds it took to elect a House Speaker for this Congress, who had to make major concessions to the right-wing fiscal conscious Freedom Caucus, this is highly likely to be a much different battle in this year. At least that's what it's shaping up to look like. That fight has actually already begun, with the Treasury Secretary Janet Yellen immediately saying because the debt ceiling has not been lifted, she has already been forced to take emergency steps to pay government expenses to avoid a government shutdown, though the emergency services would last through into June or into Q3. The reason she jumped in so quickly is the rub here is she can't issue new Treasury debt until the debt ceiling is increased and will be forced to spend down the Treasury general account until it is passed. The lack of new Treasury issuance will potentially have a major impact on interest rates if Fed funds rates and quantitative easing policies to fight inflation are maintained. As I've pointed out in my newsletter, Secretary Yellen is extremely sly, And there is a lot more going on here than meets the eye. I will leave that discussion for our newsletters, but suffice it to say, interest rate volatility can be fully expected with the fear, sudden panics, and instability that go along with a possible U.S. debt default. Another volatility trigger is likely to be delivered by geopolitical pressures as a result of the ongoing shift to a multipolar world. This will be brought to the fore with the dissolution of the petrodollar and emerging threat of a BRIC-led commodity cartel. The creation of the petrodollar system in the 1970s was a major contributor in shoring up the burgeoning U.S. trade deficit debts and President Nixon's sudden shift to a non-gold-backed fiat-based U.S. dollar. With the increasing possibilities of Saudi Arabia and other OPEC countries increasingly willing to trade oil in other than U.S. dollars, which the understanding calls for, we can expect worried markets to react. Fewer U.S. dollars required abroad to buy oil in U.S. dollars can only add to U.S. domestic inflation pressures as those dollar IOUs are returned to the U.S. as claims. We additionally worry about pressures on commodity prices as the trade consortiums of the 144 commodity export-dependent economies becoming increasingly aligned with the BRICS, that is Brazil, Russia, India, China, and South Africa, through China's Belt and Road Initiative and the Shanghai Agreement, amongst other anti-U.S. arrangements and agreements. We also see issues with falling U.S. productivity and changing demographics becoming increasingly important in 2023. Both are longer-term secular changes that are coming home to roost. Though U.S. productivity has been in a dramatic freefall since COVID-19 hit, it has realistically been in a downtrend since the dot-com bubble burst in 2000. Since China entered the WTO in 2002, tens of thousands of manufacturing facilities have left America, and everybody is fully aware of that. These were high-paying jobs. This is proving to be a mounting problem as standards of living are being reduced as the middle class in America is being crushed. As a 70% consumption economy, the U.S. cannot survive a consumer unable to continue to consume at these levels. Since the U.S. consumes more than it produces and lives on rising credit to sustain that consumption, the clock is ticking on how this will be resolved. A potential era of stagflation will only compound an intractable problem. Further overlaid on this problem is the reality of the U.S. labor force rapidly shifting demographically, with baby boomers retiring and spending less, while the student debt-laden millennials and Gen Zs replacing them are barely able to afford rents. Who's going to consume? These are not just economic and financial problems, but social problems, which increasingly the government will be expected to solve. That takes money. That's more spending. What does all this mean for 2023? It means problems for the financial markets and likely a lost decade of sustained positive market returns. However, that doesn't mean there is no investment nor trading opportunities. Quite the contrary. It will increasingly be an era for the nimble and well-informed. We'll talk about the 2023 investment themes that go with these macro themes in the upcoming long wave release. If we are right about our expectations for falling standards of living to go along with these developments, then it is extremely important that you get your investment strategy in place now. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take that money or it is simply of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be now, however, are effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis, or the ability to seek agreements. I'd like to take a moment as a reminder, do not trade from any of these slides. They're for educational and discussion purposes only. As negative as these comments often are, there has actually seldom been a better time for investing. However, it requires careful analysis and not following what has been traditionally the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. I sincerely thank you for listening.